2008, when financial crisis happened, gold was $600. In 2012, just 4 years after that, gold was $1,900.
Wow. Even after the massive rally that gold has seen, what you're saying, it is still a good idea to continue investing in gold and silver?
Because Sharan, equation has changed now. So don't see gold as a way of making money at the moment. See it as a
US market has gone up so much and the valuations are now not making sense.
Yeah.
Doesn't it make you apprehensive about investing in the US market?
Bubble or no bubble, US exposure is important. If you're missing out on US, then you're missing out on a big chunk of it. I have met people in last 15, 16 years who had to go to rehab to get away from trading.
Wow.
Bitcoin was created in 2008. What was it used for? Buying drugs, arms, ammunitions, because Bitcoin or any crypto was untraceable, anonymous. That is the reason why central banks. Solana right now, one coin is $130. Imagine if you don't buy it at all, and after 5 years, the same crypto is at 5,000 or 6,000. What are you going to tell to yourself?
I've just walked into one of Dubai's oldest investment consulting firms, Century Financials. The guest on today's episode is a global market strategist, someone who has more than 15 plus years of experience. His name is Yogesh. Hi Yogesh, how are you doing today?
Hi Sharan, how are you?
So guys, this episode is going to be really detailed, really fun, and really educational for you guys. Make sure to watch till the end if you really want to know how do the millionaires and billionaires of Dubai invest their money. So Yogesh, can we start?
Well, first of all, it's a pleasure to have you, Sharan. And I'm really excited to talk about the financial markets and what's the next opportunity. And let's take a walk.
Let's go. Yeah. Let's go, guys. Come on. Let's go, guys. Let's see how we can become the bull. Let's go. So let's do this. So today what you're doing is that you understand the client's requirements, you educate them, and you help them invest their money.
Right.
So let us do that simple exercise with me, right? So let's say I am your client. I came to you, right? And I'm like, Yogesh, please help me grow my money. And I'm looking for your expertise and your research help on what I should do with my hard-earned money as we speak in 2025.
Right. So there are a few things, Sharan, which we need to understand about investments.
Yeah.
So today, the example you're asking me, if you're a 25-year-old or a 27-year-old, I want to know, first of all, how old a person is.
So I will give you that number.
Yeah.
So let's say I'm 30 years old. I come to you. I have $1 million to invest. Help me invest and grow my money.
Okay. And this, right now, do you have a stable job?
No, I have a business and it generates free cash flows.
Okay.
So it is generating enough profits for me to live my life, and I can still save like 60-70% of my income after my monthly expenses.
Okay.
So I have a good savings rate of 60 to 70%.
And the money which you're investing right now, do you need it back in a span of 3 to 6 months or in a year?
No, I am not looking at any short-term plans. Any of my short-term goals can be fulfilled with a credit card swipe. I am just looking for taking this to the next level where I can one day probably buy a 100 crore villa in Palm Jumeirah.
You want to go all Warren Buffett on your investments.
That's right.
Perfect.
That's
So
right.
So these are few important things, right? When you are talking to a client, you want to know how old they are, how important their money is.
Yeah.
It means basically, do they want it right away? Do they have any goals for their retirement? Do you want to build up a big restaurant or travel the whole world when you get retired? How early you want to get retired?
Yeah.
And while we understand these things, we also want to understand their risk appetite.
Correct.
That's where it becomes tricky.
Right.
Everybody wants to earn money, but nobody wants to take the same amount of risk what it takes to earn that kind of money.
Correct.
So if today I tell you that I can double your money in 6 months, you would love the idea, but it comes at a risk. You're not ready to take that risk.
Right.
But you love the idea that I can double your money in 6 months. Now, the point is we have to do a proper risk analysis and understand, and we have to tell them. Because when 2008 crash happened, during that time, if you see the top 10 market companies with higher value, you would see all the utility companies, ExxonMobil, Chevron, energy stock.
Right.
But if you see in 2018, that game changed completely. The top companies were Google, Microsoft, Tesla. The tech had taken over. Now, if you had invested between those times, you would have been sitting on much higher percentage returns, right? So timing really matters. But at the same time, tech, the way it moves up, the same way it comes down also.
Right.
Right? So investors, they have the tendency to ditch tech stocks first when things go haywire. So that's why if you're a 70-year-old, I don't want to put your money in tech because that's too much adventure.
Yeah.
But for a 30-year-old, because if something goes wrong, you have another few years to recover that money. So it's okay to take higher risk. As Indians, sometimes we are told, raised in a family where we are told, don't take high risk.
Right.
ज़्यादा बड़ा risk नहीं लेना है. Because
Risk
high,
नहीं लेना है.
because high risk is it's a taboo.
Yeah.
It's like you're gambling away. But that's not the right thing. In fact, high risk means that a person understands that I'm investing in an asset which is volatile enough to generate higher returns, but it can go down as well.
Right.
Now, for a youngster, it is good to first of all do majority of the allocation to stocks. So first of all, I think around 40% of your money should be invested into equities.
Okay.
Now, within those 40%, I'm talking about, say, or at least 50% should be into equities. In that, 30% to US markets, because US has the highest liquidity as we speak. Highest bond market is in UK, but the highest liquidity you will find it in US. Because
For the audience, can you try to break down what is liquidity and why is that important when you invest your money?
Yes. So liquidity means the ability to buy and sell something real quick, which can be easily converted into cash. So when I say that US is a very liquid market, that means there are a lot of buyers and sellers in a US market, which can easily allow you to buy and sell your stocks. Plus, US has the one of the largest market cap is New York Stock Exchange, which means that the total value of the stocks, highest value of the stocks, is New York Stock Exchange. That is why US exposure is very important. Bubble or no bubble, US exposure is important. If you are missing out on US, then you are missing out on a big chunk of return. So 30% allocation there.
Out of the 50%?
Out of the 50%.
Okay.
20% should be put into emerging markets.
Okay.
Emerging markets are very important. And when I say emerging markets, I'm also dividing this money a bit into Europe, which is a developed market. When I'm talking about apart from US, this 20% allocation should be into Indian stocks combined with Singapore, combined with Czech, Polish, Hungary, which different parts of Central Europe. Because if you see Western Europe and Central Europe, Western Europe goes to Germany, France. Central Europe goes towards Poland and Czech and Hungary, which, by the way, have generated on an average more than 40% returns this year. Very few people have tracked this.
I didn't even know they had an active stock market there.
Yes, but the point is that it is happening. And why it is happening, I'll tell you. There is something called friendshoring, which is trending these days. So there used to be globalization, right? Now it is, the very important trend is de-globalization. De-globalization means countries would rather trade with their friends rather than rivals. So Germany, for example, a lot of factories have been moved from, so Germany has moved their factories to Poland or Czech just because they are nearby and they are friends. So what is happening? Polish markets are getting a lot of business, a lot of labor coming in, economy booming in, plus Europe for the first time in life, and thankfully, they've started spending money on their defense. And these bases are being formed in Poland. And that's why if you see Polish market have gone up by 50% this year. Now,
so the ability of a developing country to take the help of a developed country can change the fortune for that developing country.
Definitely can. Right? I think if you see India, for example, India at this point of time has the demographic, which means the median age right now for the Indian population is 28. 65% of Indian population is in the right age group of working.
Right.
Many developed economies, by the way, if you see the working age, it is older. That's why the many developed countries, they need more healthcare understanding because the aging population is the problem for them. In India right now, people are young, the consumption is high, incomes are rising. This is the youth, which is a mix of everything, right? So India has an excellent demographic right now. The manufacturing is doing good. And most importantly, there's political stability. I think political stability has been there for the last so many years. And it goes without saying that this is expected to continue.
Right.
So that kind of infrastructure, that kind of ecosystem India is one of the best countries to invest in right now.
Hmm.
So when you're looking at allocation, of course, out of this 20%, maybe 10% could be allocated to India. 5 or 10% can be allocated to, or 5% can be allocated to European, Japanese stocks right now.
Interesting.
Japanese stock market, for the first time in 34 years, finally they have started experiencing inflation. That has pushed stock markets to as high as 35 years. I think after 1989, so it's been easily 36 years. This is the highest we have seen Japanese equities.
Wow.
Now the point is, this is where you're looking, right? You're diversifying here. You did it in US, you put a bit into Europe, and when you're looking at Europe, you're looking at central part of Europe, which is expected to get benefit from the friendshoring, from the migration, from the defense bases which are being created. And then you're moving towards Japan, you're moving towards India. You look at Indonesia, which is also getting benefited because a lot of factories are moving towards Vietnam, towards Indonesia, just because of de-globalization. So these days, countries, so tariffs, right?
Yeah.
The moment US put tariffs on different countries, right now, for example, China. If you see real estate in China, it has plunged by 15%. You look at the industrial output, it's down 0.5% in single month. That's a big drop. Since 2020, this is the biggest the drop has been. So people are moving from China. They're more scared of investing in China. So where they would invest? India, Vietnam, other emerging markets, Indonesia, for example, Singapore, for example. So you allocate it that way. You're looking at the current trend, that's what you need to do. So 50% is allocated towards the equities. Now you're left with this 50%.
So just to summarize, that 50% equity, 30% goes into the US market.
Yes.
The remaining 20%, you're saying 10% in India?
10% in India.
And that another 10% will go into Central Europe and emerging ASEAN countries.
Yes.
Right? So that's the equity portfolio.
Exactly.
Now let's go to the remaining 50%.
Now you come to the remaining 50%, right? By the way, to everyone who's listening, this allocation can be tweaked depending upon your age.
Of course.
Right?
So we're talking to a 30-year-old person who is going all out like Warren Buffett.
Yeah. So now the remaining 50%. Now this is where it becomes really interesting, because earlier there was one thing which investors were not really excited about. And that was the precious metals. Until last 2 years, nobody thought that I have to invest in gold.
Yeah.
I have to buy gold, I have to keep it, would probably pass it on my children as a legacy, or, this is what normally the mindset is, right? Anybody who bought gold never wanted to trade.
Right.
They wanted to have physical gold with them. But in last 2 years, this has changed. Now, people have seen gold prices rising. Why? Because central banks are buying gold.
Yeah.
Geopolitical issues have gone worse.
Yeah.
Unfortunately, year on year, the world is getting worse. That's bad news, but that's how it has worked out.
Yeah.
Now, because central banks are buying gold prices have gone up. Geopolitical issues, people are worried. So gold is a safe haven. It has always been a safe haven. When people get worried where to invest and equities are falling, they turn towards gold. This has always been an idea. In 2008, when financial crisis happened, gold was $600.
Okay.
In 2012, just 4 years after that, gold was $1,900.
Wow. So what we are seeing now, right now happening with gold has already happened 20 years back.
Yes.
During the 2008 financial crisis.
Yes. And the reason behind that was that when the financial crisis happened, of course, that was the most tragic thing, because that impacted the entire world.
Right.
Retail investors lost a lot of money.
Yeah.
Bankers made a lot of money. So that
retail investors lost almost 60% of their money.
And I think there was a big photograph where they were marching towards the Wall Street, and there's a picture of the bankers and everybody sitting from the balcony sipping on champagnes.
Yeah, I remember. Huh?
So that was the time when I think Ben Bernanke, who was the Federal Reserve chairperson back then, he came up with the idea that we just need to print more currency, right? Which was famously coined as quantitative easing. And there were 4 rounds of quantitative easing.
Yeah.
More dollars they printed. Of course, the value of dollar depreciated, and we saw gold prices skyrocketing. That was the time between 2008 till 2012. You will see gold prices going in a very upward sloping direction.
Right.
In 2012, when markets recovered, obviously Fed decided to cut down this printing of money, because that would devalue the dollar more. So they would just cut it down. And while that tapering started, that cutting down started, we saw gold prices also dropping. The drop was very huge. That was the reason why between 2012 and until 2020, you have not seen gold prices going back to 1900, because that inflated price was because of the weakening of the dollar, which was because of the printing of the currency. Right.
So fast forward to today as we speak.
Yes.
You're saying how much percent of your money should be in gold?
10 to 15% should be divided between gold and silver ETFs.
So even after that massive rally, even after the massive rally that gold has seen,
Yes.
and even that silver is seeing right
Yes.
now, usually how people think is that, oh wow, it has gone up so much.
Yeah.
Now it has to come down first.
Yeah.
Then I will go buy. But what you're saying, it is still a good idea to continue investing in gold and silver?
Because Sharan, equation has changed now. It's a very different thing. So don't see gold as a way of making money at the moment. See it as a portfolio insurance.
Got it. Now, another narrative for this is that the US market, same mentality, right?
Yes.
People think that, US market has gone up so much.
Yes.
And the valuations are now not making sense.
Yes.
What is your argument to that? Like, I understand from 2023 to 2025, we've seen this incredible rally.
Yes.
And there were a lot of reasons for that. Interest rates were cut and AI was booming.
Yes.
But now there is another narrative that these AI stocks are just fluff, right? Because the earnings expectations of growing cannot be sustained. Like, there is a meme out there that if Nvidia is not able to post the quarterly earnings that is expected from them, the whole world is going to collapse. So there are meme of, Nvidia holding up the whole world.
Yes.
And this quarter, they met those targets, and actually they exceeded those targets. Even then, the market corrected by 5%. So when I hear news like this, and a lot of people are hearing news like this, doesn't it make you apprehensive about investing in the US market, considering that the market have rallied so much, like you mentioned, 40% year on year?
Yes.
So because the general thinking from a retail investor is that if something has gone up so fast, so quickly, then I probably need to book my profits and wait for the market to correct and then get back in.
So what you said is really right. The general thinking of an investor.
Right.
The term crash is thrown around like anything. It's the most common thing. The moment people see something going up, they come, this is going to go crash. Same, the word bubble, which has been now used a lot.
Yeah.
It's an AI bubble or not. See, bubbles burst when people stop asking questions. If people are asking questions about bubble, which means you're not in a bubble.
Okay.
You will be in a bubble when you are absolutely not worried about it, like 2008. Right? When people were thinking, if you talk about anyone that housing prices are going to come down, they're going to laugh at you.
Right.
There's no way housing markets are going to crash. They did. That was the bubble when people stopped asking the questions. The thing about US market, think about AI, see, we have to understand. So when I allocated your 30% to US market, I'm not putting 30% to US tech. Right?
Okay.
I'm putting probably 10% to tech, remaining 20% to quality. Your utilities, defensive sectors, right? Like, for example, if recession happens, you're not going to stop brushing your teeth. It's not like you're not going to drink a Coca-Cola, right? So utilities, defense, electricity, coal, energy kind of a sector. 20% their quality works. 10%, why I'm putting 10% to tech now? Because of this thought that while markets have rallied, if there is a possibility of a drop. So now the answer to the question, is there a bubble or not? Because this is the most popular asked question. Let's understand this thing. 2000, the year of 2000 and 1990, when dot-com bubble happened, that was the time when companies were getting themselves listed. There was a restaurant, which was a restaurant, and they added the name .com next to them, got fully subscribed. And people thought that, they're going to use some sort of technology because internet was the next thing. Restaurant name with .com. And like this, there were so many companies, schools, getting listed .com at the end and fully subscribed. By the year 99, 2000, people started getting realized that this is a restaurant, doesn't use tech for anything. Like this, there are so many companies which are just using .com in its name just to get the full subscription, but they're not using tech in any form. They started selling those shares. Hence, the bubble burst. But tell me one thing. Did internet not change the lives as it was promised it would?
It absolutely did.
It did.
Yeah.
It just didn't do it at that point, right? The question is, after every bubble burst, the genuine stock companies, they continue to evolve, right? We have to understand a difference between a bubble crash and a market correction.
Hmm.
Markets are poised for a 10-15% dip. It's very common.
Right.
It has rallied from 2023 till now. So a 10-15% correction is something which should be expected and anticipated.
Correct.
But is there a crash coming? Not necessarily, because
When you mean crash, you mean like what? 30-40%?
yeah, 30-40%. What we saw in pandemic, what we
Yeah.
saw in 2008 or in 2001.
Yeah.
Now, if you see the numbers and you see the future growth, even if there was a bubble, even the bubble burst, can we say that AI is going to disappear completely?
No.
It won't disappear. It is the infrastructure layer. It's not just a sector anymore. Today, when you are building up a product, you need to understand that where I can fit the AI into this product. This has become the stage 1 of building up a product.
Right.
So I would suggest that you feel that there's a bubble coming, no problem. Just put less exposure on that part. So take example of NVIDIA. Did anyone anticipate that NVIDIA is going to go up 250%?
No.
Because what you're saying right now, people were saying exactly the same thing about NVIDIA 3 years ago. The stock went up 250%. People didn't invest in it.
Right.
Now they're still talking the same. It is overvalued. You have to understand the cost of losing that opportunity, Sharan. Opportunity cost is a very important cost. When you don't invest in something, you are letting those returns go.
Right.
Now, for whatever reason, you're sitting on cash. Sitting on cash is not investment. Every single penny which is in your pocket right now, not invested, is losing its value.
Right.
Why banks charge each other overnight interest? Because they know that if I lend you money today, and if that money is used by you, you are generating returns over it, but I'm not getting anything out of it.
Right.
I wasted my money.
Correct.
You need to be invested in the market.
So you mentioned 10 to 15% goes into gold and silver. What about that last 35%? Where does that go?
Yes. So now, after we have diversified in metals, we are reaching to the remaining 35%. Now, out of that, I think 15 to 20% can be allocated to debt, the fixed income part.
Okay.
Right? Fixed income is when you are buying US treasuries, you're looking at corporate bonds. Corporate bonds are issued by the companies. They give you a little higher yield than normally, right? So I think, and that's really up to you how much allocation you want to do between this. This 35% needs to be divided between debt.
Yeah. Out of the 35%, you're saying 15% goes into debt.
15% goes into
So another 20 is left.
Now it's 20, right? Now out of this 20, 15% can be invested into thematic.
What is thematic?
Is the mega trends. I'm talking about DNA sequencing, talking about cybersecurity, space exploration.
So like super future stuff.
Super future stuff.
Okay.
Because so that's the thing. Space exploration is something which is a very new concept, right?
Right.
You're still not really sure how valid it is, but you know that when we talk about space exploration, all of a sudden companies like SpaceX comes into your mind. Now the point is that why allocate a certain amount to futuristic companies also? Because you never know that which sector starts booming. Before pandemic, so AI was not something which we have never talked about. We always used to talk about it. It got more serious after pandemic because the need of the hour was push yourself into this technological progress.
Yeah.
So imagine companies which will use technology to improve the fertility of the agricultural land, ag tech. Right? That's one of the important key areas. There are not many companies right now in those areas, but there are some. So you could invest, so allocate, let's say from that 15%. So the remaining percent, I think was 20% remaining, right?
Yeah.
Out of that 15% should be allocated to these themes. I'm talking about blockchain. Blockchain, not cryptos.
Right.
Blockchain, talking about cybersecurity, talking about drone manufacturing. Drone manufacturing is one of those areas which is expected to grow more in the future. You're talking about DNA sequencing. DNA sequencing allows you to sequence the DNA of your body in order to understand that what kind of diseases your body is prone to. So you can find a timely diagnosis for that.
Okay.
So these kind of things you would like to invest. This is the futuristic themes, like ag tech and all of that.
No, wait. That 15% that you're investing.
Yes.
Let's take one example. Space exploration, SpaceX.
Yes.
Now, SpaceX, I can't invest in even if I wanted to. No, it's not a publicly listed company.
Correct.
So how do I get exposure in these super trends which you're talking about?
So there is a concept called exchange traded fund
ETF.
or an ETF, right? Space exploration does not only have companies which are launching rockets in this space. The companies, when these rockets come back, they get refurbished, right? Then there are companies which are building GPS systems for these kind of rockets.
Yeah.
Then there are companies which are building engines or other kind of technology for these. All of them are combined in a space exploration ETF, right? Similarly, when you...
So there are ETFs which invest in these space exploration related companies or a part of the supply chain of these space exploration companies.
Yes. Like when you do a EV ETF, you don't just buy Tesla.
Correct.
You even go for those companies which are creating packaging for lithium batteries. You're also investing in EV infrastructure stations, right? Those who are making EV charging stations.
Right.
Even those companies are put in. So the advantage of the ETF is these new areas, they're very risky, right?
Correct.
Space exploration is good for now. Maybe tomorrow it just disappears. Nobody cares about it.
Right.
So if you put your money into one of those companies, you have a chance of losing that. But if you put it in an ETF, it kind of diversifies your exposure in a systematic way, in a less riskier way it should.
Got it.
The point is that if you are completely away from this, you will never get to know the good and the bad part of it. So if you're scared of something, put less money. So my remaining 5%, by the way, was supposed to go to the virtual assets, which is your cryptos. Earlier, I would allocate only 1%. But after seeing now the amount of institutional flow which has gone into cryptocurrencies, I would increase my exposure to 4 to 5%. But that 5% not to the meme coins, not to Squid Game coins and all that nonsense, something which solves the problem of a higher magnitude. Like for example, Ethereum, Solana. These are the kind of cryptocurrencies which are sustainable in mining, and Ethereum is like an internet to the crypto world. Same goes for Solana, can do everything what Ethereum can, but more sustainable in mining. So people would want to look forward to these kind of cryptocurrencies, and the denominations are very small, very low. Solana right now, one coin is $130. It was $270 3 months ago.
Okay.
Now you are getting it for $130. One coin. Imagine if you don't buy it at all. And after 5 years, the same crypto is at 5,000 or 6,000. What are you going to tell to yourself? Risk, take the risk. But the composition needs to be tweaked. If you feel that crypto is a sham, don't do 5%, put 0.5%.
So one question I had about the crypto space, that you mentioned that you should have 4 to 5% of your money in crypto or even lesser. Right? But why do you feel that the central banks are a little wary about cryptocurrencies? I mean, of course, there are some economies like the United States which are very, very pro-crypto, primarily because of the Trump becoming the president. He launched his own coin. But if I look at India, the RBI is very wary about crypto, right? They at one point of time they also gave like a soft threat to the banks that don't deal with any crypto exchanges. Right? If you allow transaction of INR converting into Bitcoin, I'm not going to tell you stop doing it, but I'm not going to like it. It's like a passive aggressive mom. So why is the Indian central bank so against crypto?
Every central bank is against crypto, but the biggest problem with the cryptocurrency is what? It's an encrypted currency. It's anonymous. Why central banks have a problem with crypto? Because you cannot trace a transaction which is done through a Bitcoin or through any of these cryptocurrencies. Why the cryptos never got a regulation? Because when Bitcoin was formed, when it was created in 2008, and Bitcoin was a birth of anger which was amongst people. Because when they saw the 2008 meltdown and the retail investors, when they lost their money, they were so pissed off with banks that they said that how banks got this authority to manipulate us in putting money into these junk bonds which would just disappear, because they know that we have money in the account and they manipulate us like this. You know what? We should have a currency which banks should never know. If I am transferring to you, only you and me should know, but no one else should know about this. Let's create a currency which is encrypted, which is anonymous, which is hard to trace. Bitcoin was created in 2008. The moment a currency was created, which was anonymous, which was accepted by a few people. What was it used for? Buying drugs, arms, ammunitions, being paid as a ransom to people to get jobs done. Every single illegal thing which could be done, because Bitcoin or any crypto was untraceable, anonymous.
Right.
That is the reason why central banks have not regulated it, because the implications and the consequences of this kind of currency in the system, that can be very different. Second thing is, why the case for crypto is so strong. If we know that it's never going to get regulated, why we are so crazy about Bitcoin? Because Bitcoin carries the technology which solves the purpose of a cross-border transaction. It brings the technology that today, if somebody has to transfer money from UAE to Europe, it would be done within a very close interval without any high processing cost, because normally it takes a week from our bank to reach out to the correspondent bank there, correspondent bank of my bank, correspondent bank of that bank, and then finally it takes a 1 week and around 1% of the transaction fee.
Right.
So imagine somebody transferring 10 million euros. It's costly. My case for crypto is never a long-term investment. Right now, it is a speculative thing. But when it falls like this, from 120,000 to 80,000, you could just buy like 0.1 of Bitcoin and just forget about it. So for cryptocurrencies, I would still tag it as speculative. For blockchain as a technology, I definitely see it going higher in the next few years and companies adopting to blockchain. Louis Vuitton is already doing it. They have adopted blockchain in their system to prevent the counterfeiting of their products. Oracle has created their own blockchain. Walmart is using blockchain through Amazon to ensure the safety of their food products. So blockchain is something which is very promising. I feel if you were to invest, you would invest in any company which is into blockchain. So you could always invest into these kind of companies. There are blockchain ETFs also which are being prepared, which have those kind of companies in it. Best way is use the ETF for such kind of exposures.
Got it. So now let's come to the speculative investment part. You mentioned about learning how to trade your money, because that was an interesting thing that you mentioned, that you can now take a leverage of 10x.
Correct.
Meaning, let's say I start with trading 5% of my net worth. Let's say I have 10 lakh rupees, I traded 50,000 rupees.
Correct.
I can take a leverage of 10x.
You can actually take a leverage of 100x.
100x also?
Yeah, but that's very aggressive.
Okay.
Yeah.
What do you do?
I go aggressive in my account.
Okay.
But you have the choice.
So let me assume I take a leverage of 10x.
Yeah.
So 50,000, meaning I can invest like at 5 lakhs.
Yes.
So with 5% of my portfolio, if I'm trading,
Yes.
What is your advice as a professional trader who has been doing this for almost 15 years?
Yes.
And I want to invest by taking leverage. Good or bad idea? And how should I go about this entire journey?
Definitely a good idea. Definitely a good idea. Leverage is a double-edged sword. You use it wisely, your investment multiplies. Use it unwisely, your pain multiplies.
Correct.
So you have to understand leverage is a very beautiful thing. It's basically you are borrowing money from the broker and investing. Borrowed investing is not wrong.
Okay.
Because if you are able to borrow at a cheaper cost, invest and earn, that's a good trade. The only problem is when you borrow too much and you're taking a very high risk and you're not keeping any risk management techniques. That's the problem. So why people, the moment you say leverage, people get scared. The moment you say leverage trade or 10 times or 100 times, they get scared. Because they feel that I'm going to lose my money. Because that's what they have heard from every single person who have lost money, that never do leverage trading.
Correct.
I would still not agree with the number with SEBI said that if 98% of the people who are trading, if they're not even able to beat the benchmark returns, then you're doing it wrong.
Okay.
I have to understand this.
Right.
Because
obviously majority of the retail investors don't know what they're doing.
Yeah.
It's
so
only,
that's the problem.
Most of them are losing money for a reason.
That's the problem because trading requires clarity, discipline, and most importantly, protection. You go without protection, that's the problem. So clarity means knowing your product. How much gold moves in a day? How much crude oil moves in a day? Gold moves $45 to $50, $60 in one day. Crude oil moves $1.5, $2 in one day. NASDAQ moves $200 in one day. You see this average movement, right? So you need to have clarity. if I am doing in gold prices, how much they have moved in last 1 week, understanding where the market is. So you need that clarity that if I'm investing in gold, I should know that this volatility is expected. So that is clarity.
Because volatility is good for a trader. That's when you make money.
Exactly.
Right.
So volatility is opportunity. We always say that where there is volatility, there is opportunity.
Correct.
Now, when you have addressed this clarity part that, okay, this is this much volatile, now you go to the next part, which is protection. Now, protection or safety. Safety means diversify. You don't do one trade all this. So they say never marry an instrument. This is a very common thing which I have seen sometimes in the clients we handle. That Yogesh, I'm not going to trade in anything else. I've seen gold enough. I'm expert in gold. I will only trade in gold. Okay, then you will lose in gold if gold trade goes against you. Because you're only focused, concentration risk. You're only focused on one product. That's never the right way. Diversification, because gold and crude oil are not related. Crude oil and Nasdaq is not related. Nasdaq and euro dollar is not related. You need assets with zero correlations with each other. So you can build a portfolio and you keep your risk reward as 1:2, which means if the prices go down and you're losing $1, you close your trade. But if it goes up $2, then you book a profit, which means if you have done 10 trades, and I'm telling you today, if you have done 10 trades, let's say your losing rate, your call rate of going your trades right, you are wrong 60% of the time.
Okay.
So out of your 10 trades, 60% of the time you're wrong. So your 6 trades goes in a loss.
Okay.
Which means the price drops by $1, you book your trade loss. 1 into 6, $6 you lost.
Correct.
40% of your trades go right, 4. But when profit goes to 2, 4 into 2, 8.
Okay.
Because each loss you book a profit twice that loss.
Okay.
In that case, even if 60% of the times you are wrong, you will still end up making a net profit.
Because $8 profit, $6 loss, $2 profit. So you're saying the game is to understand the risk reward ratio.
Risk management. Trading is never. So sometimes I talk to people, they say, okay, tell us, we will invest with you only if you tell us that how many of your calls have gone right. It doesn't matter. Because I could have given you 100 calls. Out of 100, even 90 would have gone right. But if your risk management is poor, you would make a loss even then. Because you might have booked profit in 89 of them, but you lost your 100% capital in one of those trades which went wrong.
So they wipe out the capital.
Yes. Trading is about risk management. So clarity.
I think most people look at that win ratio.
Yeah.
How much percent of the trades are right.
Yeah.
But that is not as important as your risk management.
Of course.
Because so that risk reward ratio, if it's optimized, you can actually be wrong more than 50% of the time, but still end up making money.
Yes. I have met people, I have seen people in last 15, 16 years who had to go to rehab to get away from trading.
Sort of like that kind of an addiction.
Yes.
They will go for rehab.
Yes.
Wow.
So if you have to do this, then you're not doing it right.
So Yogesh, if I had to ask you, how do you become my consultant? Like I'm asking for the audience as well.
Yes.
Because I think we've been hearing you for the last 1.5 hours, and I'm sure a lot of them will be like, okay, Yogesh, aapke saath kaam karna hai. How do I work with you? How does that work? So do I need to be a millionaire firstly, or can I start?
Definitely not.
Okay.
In fact, I wish that you become a millionaire after you work with me.
Okay.
But with all the regulatory disclaimers, I don't want to highlight on that part. But the simplest thing is that even if you have $100, you can be an investor. People do SIPs also. So some of the investors who have joined, who have seen these kind of sessions, and when they have joined with a very smaller amounts, I particularly educate them that, see, even if you have a smaller amount, just start creating a systematic investment plan for yourself and bring that discipline in your life. At every 15th of the month, I will put $100 in a S&P 500 ETF, right? So today, even if whatever money you have, you need a consultation, first of all, from Century consultation or education about products. It goes absolutely free of cost.
Okay.
We do one-on-one sessions with people who want to learn about financial awareness.
That's also free of cost.
Absolutely free of cost.
Interesting.
We don't charge for the sessions. We don't charge for training and educating them on the markets. Once they understand what they are getting into and what are these things about, they can always open investment accounts, trading accounts, and we'll help them with our consultation. We prepare a lot of research reports. Around 120 research reports have been generated in 1 month when the events have stimulated that effort. So when it has been like, if I would tell you the stories from 2016, when the night of the US elections, everybody was in the office, the results are coming out 2 a.m., 3 a.m., and you will see clients sitting with us discussing about US elections.
Interesting.
So the idea is to make you independent so you can take your own investment decision, but not to leave you alone here, right? In fact, everybody who's listening to the podcast right now, we are trying that once these sessions are over, there is a free of cost research report on gold, which can be sent to you, and you can send it to your listeners.
We'll put it in the description down below, guys.
Yeah. So that we can do that. And as I said, anyone wants to book a one-on-one session regarding the consultation, it is absolutely free of cost.
Okay, perfect. Yogesh, I think that was a phenomenal masterclass on international investing. And you are like a walking encyclopedia. You know everything about everything. I personally learned a lot of things today. Any last piece of advice you would like to give our audience who've listened here for so long?
First of all, Sharan, that's very generous of you. I think what you're doing is a wonderful thing.
Thank you.
Meeting people from different sectors and bringing information away from the noise. That's the hardest job of any influencer.
Thank you.
You doing it and getting it to the audience. And this is one of the most sensitive topics, financial services.
Right.
So
should have asked this in the beginning. Good things about me. Thank you.
No, I mean, there's no doubt. What you're doing is one of the most difficult things.
Thank you.
Like anybody, I think, who sees from the outside feels that, oh, okay, views generated. But the thing is to ask the right questions and to sit and listen to that information. It takes a bigger person to share the knowledge, but it takes even a bigger person to sit and listen to it.
Right.
Especially somebody who has listened to so many people and so many things. So first of all, congratulations for doing such a great job. And thank you so much for allowing me to sit and talk for so long. One piece of advice for everyone, which I definitely want to give. First, to definitely read your book, which I saw you posing in front of the camera. And most important thing is always invest. It does not matter what age you are at. In fact, younger you are, earlier you start investing, compounding will do the impact. Create your SIPs, think about investment. Trading is the last bit. But think about investments. Always have an investor mindset.
Absolutely. All right, guys. That brings us to the end of our podcast. Thank you so much for watching till the very end. I'm sure you've become 10 times more smarter if you've been listening patiently throughout this entire conversation. If there are any questions that you felt like I did not ask, please drop them down below. Me and my team will try to answer them. And if there are any future guest recommendations that you would have, that you would like me to bring, I will bring them on this channel. And as always, I'll see you in the next one. Before you go, guys, if this episode gave you even one insight that made you think differently about money, don't just keep it to yourself. Share it with your friend or family member who could use it too. And if it sparked a new thought or even made you disagree with me, drop a comment below and tell me why. Your critique helps me make these conversations sharper and more useful for you. As long as you have me subscribed, I'll make sure that you walk away with at least one new thing every Wednesday.